Thank you for tuning in. Hello, everyone. Today is Wednesday, June the 4th, and this video is going to be about a covered call and what it actually is. And I can spend a lot of time on this, but I'm going to try to limit it to under 10 minutes because it's very important to me to try to help people understand that when they're selling a call and writing a call, a covered call, allegedly for income, when you hear someone say that you're going to sell this call, a covered call for income, the red flags should go up and the alarm bells should go off. And I say that because the person probably doesn't know what he's talking about. Or the person is a grifter, or could be a combination of both. They don't know what they're talking about. They're a grifter, and possibly they actually do know what they're talking about, and they're a grifter. So let's jump into this. Let me get away from this screen. I was looking at something that I might do later on this afternoon. But anyway, all right. So I already set this up. Let me home in on what I have here. So, all right. Let me see if I remember how to do this. Where's my zoom in button? You need to zoom in 100%. All right. So what we're going to do is, in this example, is we're going to have two positions. All right. We're going to have two positions. One position, we're going to own 100 shares of stock, and we're going to write a call against it. And in this example, I'm going to use the 103 strike for the call. And just for illustration purposes, we can simplify things. And I'm not going to get into specifics about the expiration, implied volatility, interest and dividends, and so on. So this is going to be a very simple example, but it will serve to illustrate the point. Position number two is we're going to be long 75 shares of the stock at a price of 100. And the reason I'm using 75 shares is because in position one, we're going to assume that the call that we sell at the 103 strike is going to be a 25 delta call. All right, so let's take a look at what I have set up here. So again, position one, we're going to buy 100 shares of stock at a price of 100. And then we're going to sell the 103 call, and we're going to collect 70 cents of premium for it. And note the terminology I used here, premium because it is not income. Regardless of what you hear, it's not income. So anyway, let's continue. All right. So let's look at the columns that we have here. Down in this column E, I just have various prices for the underlying stock. And then the column next to it, column F, we have the value, actually the P&L of the call that we sold at 103. So note that at expiration, if the stock price is at 90, the call is going to be worth the premium we collected because it's going to go out worthless. No one's going to buy. No one's going to pay $103 for a stock that's trading at 90, at least no one who doesn't live in the cuckoo's nest. So you keep the premium of 70 cents, which was 70 bucks, times the multiplier of 100, 70 bucks. Go down, same thing. So for all prices at or below 103, you keep your $70 premium. And yes, I'm ignoring transaction costs such as commissions and exchange fees and so forth. But again, we can ignore those things because it's what I'm doing here. The numbers will still illustrate the point. Let's continue. And above, prices of 103, you're going to start to lose money here. So since the call, you're obligated to sell 100 shares of the stock at 103 if it gets exercised. At a price of 104, you're going to lose $100 minus the premium you collected at 70, so forth and so on. So with every increase in price, you're going to lose $100 minus the premium you collected of 70. So note that, for example, here price is 110, $700 is your loss minus the premium of $70, so you lose $630. All right, you buy the 100 shares at a stock price of 90. You own 100 shares at 100, you're down $1,000. This is pretty straightforward. For prices below, prices for every $1 movement, you're going to gain or lose $100 because you own 100 shares of the stock. So this is pretty straightforward. And then the next column here, we have the P&L for, I'm going to call this P1, position 1. So if the stock goes down to 90, we're going to lose, rather than $1,000, you're going to lose $10 on 100 shares, which is $1,000 minus the premium you collected for selling the call at the 103 strike. At the stock price of $100, you break even on your shares of stock, which is here, but you make $70 on the call, which is premium that you sold for the call. If we continue to see what happens when stock price closes above 100 at expiration, note that once we get to 103, you're going to make $300 on your stock position, on your shares. However, your call, the call that you sold, will get exercised, and you're going to start to lose money there. So you're going to cap. You're not going to lose money. You're going to cap. You're going to cap your profits. Let me make sure. Do I have this correct? Done correctly? Or minus. You're capped at the profits you're going to make. Okay. So again, remember that we were assuming in this hypothetical that the 103 call had a delta of 25. So let's say for position 2, rather than selling this call, you just shaved your position by 25 shares, because at the time when the stock was trading at 100 and you owned it at 100, this call was a delta of 25, which is roughly equivalent to 25 shares. So rather than selling the call, you're just going to sell 25 of your 100 shares, and that will leave you long 75 shares. Same day that these calls that you no longer own expire, stock is at 90, so you're going to lose $75 as opposed, or $750, 10 times 75 is $750, as opposed to losing $930, which is what you would have lost in position 1, where you own the shares and you wrote a call. You sold the 103 strike call. All right, so between 90 and 100, we note that going from the price of 90 and increasing from there, note that your loss on 75 shares of stock is getting better and better, because you want it to go higher, you own the shares. However, when you compare it to position 1, note that you're better off as the stock goes down, only owning 75 shares as opposed to owning 100 shares and being short the call. Okay, in the area between 100 and 103, you're still making money, but you're going to make a little less than in position 1. And the reason is because it should be obvious. In position 2, you have 75 shares. So as the market's trading above prices of 100, you are going to make less than owning the 100 shares outright in this region between, let's just say at prices under 103, and we're going to bound it at 103, and let's just say 100 for simplicity's sake. Note that in this area, this region, you make less in position 2, in which you own 75 shares. So let's continue up the ladder and note what happens here. Position 2 at prices, once you start to go above 103, 104, position 2 is going to be better off for you, where you just own the 75 shares as opposed to owning 100 shares of stock and selling the call short, because the call caps you. The call is going to cap your earnings, what you can make. So you're better off with the 75 shares. Now, this column J, it shows the difference between the net between position 1, in which you own the 100 shares and you wrote the call for income. Ugh, hurts me just to hear that. Versus long 75 shares. So note that owning 100 and selling the call, you have this region between 98 and let's say 103, where you're outperforming being long 75 shares. But once you go above this boundary of, let's just call it 104. Once you go above this boundary of 104, being long 75 shares is a better position than being long 100 and short the call. Again, because you're capped. So rather, I guess I'll go over this real quick. This breaks down each of these components individually. So for note here, I'm going to zoom in a little bit so we can see the legend. Where am I? Let's go up some. There's a keyboard way for this, but I've forgotten how to do that. All right. So this legend breaks down the individual components. And again, note here that this linear line, the dark green one, this is 100 shares. And again, owning 75 shares, you're going to be better off as far as losses are concerned when the underlying goes down. And as the underlying goes up, 100 versus 75, well, clearly the 100 is going to be better. And again, this just breaks down the components, the legs, the individual legs of this. Now, what I want to emphasize here is, again, what is this position actually when you're long the 100 shares and you sold the call? Is that an income generating position where you get to benefit from being long stock and then you magically receive an extra 75 or 70 bucks because you sold a call at the 103 strike? Well, yes and no, and here's what I mean by that. So this graph shows the net position 1 versus long 75 shares. And when you look at the net of this, what this looks similar to is a straddle or some other structure in which you are short volatility. So whether you know it or not, when you own the stock and you sell a call, what you're doing is shorting vol. And this clearly shows it. And in this region, you do okay. Since you shorted vol, you want volatility to go down. And in this area, it's helpful with the peak being around the 103 area. But then it gets worse as prices increase. And it gets worse than the apex here when prices decrease. So this whole selling calls for income, I really think people overlook or are oblivious to what's going on. And there are a number of reasons for that. A lot of that, some of it has to do with you're gonna trust the expert, or people trust the expert, or people trust the allegedly more knowledgeable person. And yeah, I guess if you don't understand how options work, or how different structures gain or lose money, they would know more than you, but that doesn't mean that they actually know what this is or what they're talking about. And again, they might just be grifters. Sell options for income. Make some income. No. What you're doing when you own the stock and you sell a call is you have a short position. Short vol, that is. You don't have a short position. Let me correct myself. Your short vol. So this is this structure, this covered call is short volatility. And going back to our choices, yeah, if you really want to be long these shares, you want to be long 100 shares, then why are you selling the call? Or to produce income? Are you really creating income? I don't think so. And look at what happens if, rather than selling an option, selling a call, in most instances, you're going to be better off buying the shares. Well, I shouldn't say most instances. There's quite a bit of time where you're going to be better off buying being long fewer shares than 100 in this case, and not selling the call. And it all depends on the volatility of the market. Now, you might luck out and you're going to get the best of both worlds, where the market's slowly going to creep up and it's going to close at expiration right around the apex of your structure. And yeah, that's great when it works out. But if you think of this as let's just imagine that all of this is a roulette wheel and it's going round and round and round and round and round and round, and you think it's going to end up right at the apex of your position and it just goes and doesn't work out for you, or it goes the other way, keeps going, doesn't work out for you. Either way, this can be a very, very small sliver and the roulette wheel, and you got to drill it to max out on this. So again, it's important to understand what the structure actually provides for you, and where your risk is, and what price are you getting or paying for whatever structure you end up creating. Now, just selling this call as income, once you hear that, all the warning signs should start flashing or blaring in your ears. Something's not right. And this, I hope, explains why it's not right. So be careful. Beware of the grifters. There are many of them out there, and they will be more than happy to take your money. All right. Thanks for watching. Catch you guys next time.